In recent months, there have been concerns about the financial health of some banks due to the COVID-19 pandemic and its impact on the economy. Some experts predict that a wave of bank failures may be on the horizon, and that Silicon Valley Bank was only the start. But are these rumors true? And what about the Great Reset? The first thing to understand is that many major banks are a publicly traded stock option like anything else. Silicon Valley Bank was not the only bank like this. Wells Fargo, Bank of America, Chase Bank, and many others are also publicly traded on the stock market. The biggest concern right now is that investors are withdrawing their investments in financial institutions in near record amounts, which could cause the whole global banking system to crater. The International Monetary Fund noted that a whopping 15% of the global financial system investment portfolio was taken out by investors since the beginning of 2023. This matters because most major currency systems, financial systems, and world powers are backed in large part by bonds and stock market shares. Most of this investment is tied up in portfolios, where investors park their money for other people to manage. One such example of this is a mutual fund, where a person hands over their money to a financial institution like Charles Schwab, and then portfolio managers figure out where to distribute it. Now, you may be thinking that 15% isn't such a big number. However, the International Monetary Fund notes that this number is the highest seen since the financial crash of 2008. So, you may be wondering, should I have my money in the banks or not? And, more importantly, what if my bank fails? Are my assets protected? This falls into the purview of what is called Federal Deposit Insurance Corporation, or FDIC, insurance. FDIC Insurance is a government-backed program that provides deposit insurance to protect depositors in case a bank fails. In America, FDIC Insurance covers up to $250,000 per depositor per account ownership category in case of bank failure. The program was established in response to the stock market crash of 1929, when banks were unable to give people their money. But now you may be thinking, how do I know if this means that my assets are still covered? Well, your bank will say if they are FDIC insured. Usually, there will be a sign posted stating they are. So, what this means is that the federal government guarantees that if your bank goes belly up and they are FDIC insured, that the government will give you every single penny you have deposited, up to $250,000. However, the federal government has shown willfulness to exceed that amount in the case of both Silicon Valley Bank and Signature Bank in New York City. A joint statement on March 12, 2023 from the FDIC, Treasury Secretary Janet Yellen, and Federal Reserve Board Chair Jerome Powell stated that all deposits, including those exceeding the $250,000 maximum, were covered. However, the one caveat, according to the statement, was that shareholders and, quote, certain unsecured debtors were not covered. Investopedia explains that an uninsured debtor is someone who owes a loan that was not secured with collateral, meaning that they do not give anything up if they can't make the payments anymore. So, what can we learn from this? For one, the federal government is likely to bail out any other banks that fail, even with some measure of certainty for those who have more than $250,000 in their bank accounts. However, if you are paying a debt to a bank, you should probably work on paying that back ASAP, or figure out a way to bargain if things go south, since your debt might not be covered and the bank might repossess your belongings. If you feel the need to withdraw your money, it's your decision. But since the federal government has promised to insure deposits up to $250,000, you will likely get your money back assuming you have less than $250,000 parked. Thanks for watching. If you liked what you saw, please consider supporting us at buymeacoffee.com/morningwoah.